My topic is penetration price in detail explain, and let's go to the topic and let's go to the start. Penetration price refers to a pricing strategy that involves offering a product or service at a low initial price to enter a new market or to increase market share. The goal of this strategy is to attract price-sensitive customers, generate sales volume and establish the product or service as a market leader. The low price could be temporary or permanent, depending on the company's goals and strategy. Once the company has achieved its objectives of increasing market share, it can gradually increase the price to reflect the product's value and to maintain its profitability. Penetration pricing can be an effective strategy for companies that are launching a new product, entering a new market, or facing stiff competition. By offering a lower price point, companies can quickly build brand awareness, gain customer loyalty, and generate revenue. This strategy is particularly effective for products that are easily comparable to existing products, as price becomes the main consideration for consumers. However, there are also drawbacks to penetration pricing. Lowering prices can also devalue the product in the eyes of the consumer and can create the perception that it is of lower quality. Once the company increases the price, customers who were attracted to the lower price may be reluctant to pay the higher price or switch to a competitor who offers a lower price. Overall, penetration pricing can be an effective short-term strategy, but companies should carefully consider the potential long-term effects on brand value and profitability. Penetration pricing is a marketing strategy used by businesses to attract customers to a new product or service by offering a lower price during its initial offering. The lower price helps a new product or service penetrate the market and attract customers away from competitors. Market penetration pricing relies on the strategy of using low prices initially to make a wide number of customers aware of a new product. The goal of a price penetration strategy is to entice customers to try a new product and build market share with the hope of keeping the new customers once prices rise back to normal levels. Penetration pricing examples include an online news website offering 1 month free for a subscription-based service or a bank offering a free checking account for 6 months. Penetration pricing is a strategy used by businesses to attract customers to a new product or service by offering a lower price initially. The lower price helps a new product or service penetrate the market and attract customers away from competitors. Elastic goods are the best types of goods for penetration pricing, as small changes in price often lead to large changes in demand. Penetration pricing comes with the risk that new customers may choose the brand initially, but once prices increase, switch to a competitor. Companies often entice customers with unprofitable strategies, i.e. offering a new cell phone, in exchange for a long-term agreement, i.e. a multi-year service plan. Penetration pricing is a pricing strategy that is used to quickly gain market share by setting an initially low price to entice customers to purchase. This pricing strategy is generally used by new entrants into a market. An extreme form of penetration pricing is called predatory pricing. Rationale behind penetration pricing. It is common for a new entrant to use a penetration pricing strategy to quickly obtain a substantial amount of market share. Price is one of the easiest ways to differentiate new entrants from existing market players. The overarching goal of this pricing strategy is to capture market share, create brand loyalty, switch customers from competitors, generate significant demand, looking to utilize economies of scale, drive competitors out of the market. Situations where penetration pricing works effectively. When there is little product differentiation. Demand is price elastic. Where the product is suitable for a mass market, and, therefore, for utilizing economies of scale. High adoption and diffusion. Penetration pricing enables a company to get its product or service quickly accepted and adopted by customers. Marketplace dominance. Competitors are typically caught off guard by a penetration pricing strategy and are afforded little time to react. The company is able to utilize the opportunity to switch over as many customers as possible. Economies of scale. The pricing strategy generates a high sales quantity that enables a firm to realize economies of scale and lower its marginal cost. Increased goodwill. Customers that are able to find a bargain in a product or service are likely to return to the firm in the future. In addition, this increased goodwill creates positive word of mouth. High inventory turnover. Penetration pricing results in an increased inventory turnover rate, making vertical supply chain partners, such as retailers and distributors, happy. Pricing expectation. When a firm uses a penetration pricing strategy, customers often expect permanently low prices. If prices gradually increase, customers may become dissatisfied and may stop purchasing the product or service. Low customer loyalty. Penetration pricing typically attracts bargain hunters or those with low customer loyalty. Said customers are likely to switch to competitors if they find a better deal. Price cutting, while effective for making some immediate sales, rarely engenders customer loyalty. Damage brand image. Low prices may affect the brand image, causing customers to perceive the brand as cheap or poor quality. Price war. A price penetration strategy may trigger a price war. This decreases overall profitability in the market, and the only companies strong enough to survive a protracted price war are usually not the new entrant who triggered the war. Inefficient long-term strategy. Price penetration is not a viable long-term pricing strategy. It is usually a better idea to approach the marketplace with a pricing strategy that your company can live with, long-term. While it may then take longer to acquire a sizable market share, such a patient, long-term strategy is more likely to serve your company better overall, and less likely to expose you to severe financial risks. Penetration pricing is a marketing strategy that involves setting a low initial price for a new product or service to quickly gain market share, attract customers, and establish brand presence. Penetration pricing is often a temporary strategy companies employ to establish an initial customer base. Companies may raise prices after they have successfully captured their targeted market share. It is important to use this strategy carefully because it can create an expectation of low prices, making it difficult to sustain customers long-term. If done well, penetration pricing can help you quickly gain a foothold in the market, whether it's for a new product or when entering a new market. For example, when Microsoft launched the Xbox gaming console in 2001, it sold the console at a loss to undercut market competition, mainly from the Sony PlayStation 2. This strategy helped Microsoft quickly gain significant market share in the gaming industry. Additionally, the company must be prepared to sustain the lower price point for a significant amount of time, as raising prices too soon can result in negative backlash from consumers. Furthermore, penetration pricing can also lead to a price war with competitors, which can ultimately hurt profitability for all parties involved. It may also be difficult for the company to cover their costs and maintain profitability while selling at a lower price point. In conclusion, penetration pricing can be a useful tool for companies under certain circumstances. However, it is important for companies to carefully consider the potential long-term effects and to have a clear plan for sustaining the lower price point. Companies must also be mindful of potential negative consequences such as damaging brand reputation, attracting price-sensitive customers who may not be loyal, and the possibility of price wars with competitors. Therefore, companies should consider penetration pricing as part of a broader pricing strategy, taking into account their overall business objectives and the dynamics of the market in which they operate. They should also assess the long-term viability of a penetration pricing strategy and its potential impact on their profitability. It may be necessary to adjust pricing over time as market conditions change and competitors respond to pricing actions. In addition, companies should communicate their pricing strategy clearly and transparently to customers to avoid any misunderstandings or negative perceptions. Overall, penetration pricing can be an effective tactic for companies to gain market share and attract new customers, but it should be implemented carefully and strategically while also considering potential negative consequences. Price skimming is the inverse of penetration pricing. While penetration pricing lowers the price of products to quickly gain market share, price skimming is a strategy where you set the price of your product higher than the current market price. This pricing strategy aims to target early adopters who are willing to pay more for a unique product or its value, based on the perception that the product or service is unique or the best in the market. Price skimming allows you to generate revenue and market products as high quality and exclusive items. Companies might gradually reduce the price of the product to sustain and expand their customer base. Target market analysis. Defining your target market is fundamental to understanding customer requirements, preferences, and their willingness to pay for your product features and services. Target markets can be defined by behavioral and psychological characteristics, which can be used as a foundation for setting a penetration price. You can use methods such as surveys, focus groups, and interviews to understand what motivates your customers to buy. You can also gather data on your competitors to compare how they price their products and services. This information will help you get a clear picture of the market demand and the pricing points that are most attractive to potential customers. Competitive analysis. Identify and research your competitors to analyze their products and services, as well as their pricing and positioning strategies. Understanding your competition will help you differentiate your product and create a competitive penetration pricing strategy. One way to evaluate your competitors is to use a SWOT analysis to identify your competitors' strengths, weaknesses, opportunities, and threats. The main objective of a SWOT analysis is to raise awareness of the variables that influence business decisions and strategies. In other words, you are examining the internal and external factors that affect your company. It's important to keep in mind that you should not base your pricing solely on what your competitors are charging. Instead, use their pricing as a benchmark and think about how you can add value to your product or service to justify a higher price point. Additionally, consider factors such as distribution channels, brand image, and customer loyalty when crafting your competitive analysis. Demand estimation. Perform market research to estimate potential demand for your product at different price points. This will help you create an optimal penetration pricing strategy to obtain market share and maximize revenue. A few ways to estimate demand include surveys, historical sales data, and conjoint analysis. Conjoint analysis is a powerful tool that allows you to measure how customers value different features of your product and make trade-offs between them. It can help you understand which features are most important to your customers and how much they are willing to pay for each feature. By estimating demand at different price points, that will maximize revenue while still attracting customers. This information will also help you develop pricing strategies that take into account changes in market conditions and customer preferences over time. Customer interviews. Interviewing customers or gathering feedback through surveys and focus groups help you understand customer requirements and their willingness to pay for your product or service. Customer interviews are an excellent way to gather qualitative data on your target audience. Through one-on-one conversations, you can gain insights into users' pain points, motivations, and expectations, insights that can and should inform your pricing strategy. When conducting customer interviews, be sure to ask open-ended questions that encourage detailed responses and allow customers to share their thoughts and opinions freely. Additionally, consider incentivizing customers for their time with discounts or swag to show your appreciation for their participation. Price testing and monitoring. Experimenting and testing different pricing strategies can help determine the optimal penetration price to obtain market share and maximize profits. Based on the insights you gather, you want to keep adjusting your pricing strategy and continue to monitor it over time. Evolve your strategy with changing marketing conditions and customer feedback. Price testing and monitoring are ongoing processes that allow you to evaluate the effectiveness of your pricing strategy. It's essential to track how customers respond to changes in your pricing, including whether they are willing to pay more or less for your product or service. It's also important to monitor market trends and adjust your pricing strategy accordingly. For example, if a competitor lowers its prices, you may need to adjust yours to remain competitive. Regularly analyzing data from price testing and monitoring will help you make informed decisions about when it's time to adjust your prices. It's also important for companies to consider the potential impact of penetration pricing on their brand image and long-term customer loyalty. While attracting new customers with low prices can be beneficial in the short term, it may also lead to a perception of low quality or a lack of value in the eyes of consumers. This can create challenges in retaining customers in the long run and may ultimately harm profitability if consumers become less willing to pay higher prices later on. Furthermore, companies must also carefully evaluate their cost structure and margins to ensure that they can sustainably operate with lower prices. Penetration pricing may require significant investment in marketing and advertising to generate demand, which can further impact profitability. It's important to carefully analyze the potential costs and benefits of a penetration pricing strategy before implementing it. Overall, penetration pricing can be an effective way for companies to enter a new market or gain market share, but it must be implemented strategically and with careful consideration of potential negative consequences. By assessing their cost structure, carefully communicating their pricing strategy to consumers, and regularly monitoring market conditions, companies can successfully implement penetration pricing to achieve their business goals without sacrificing long-term profitability or customer loyalty. Term profitability or customer loyalty. Additionally, It's important to note that using penetration pricing as a long-term strategy may not be feasible in all industries. In some sectors, such as technology, prices may naturally decrease over time due to advancements in manufacturing processes and technology. In these cases, companies may need to rely on innovation and differentiation rather than pricing strategies to remain competitive. Ultimately, the key to successfully implementing penetration pricing is to balance short-term gains with long-term sustainability. By carefully evaluating market conditions, understanding customer needs and perceptions, and maintaining a flexible pricing strategy, companies can use penetration pricing to capture market share and increase profitability without damaging their brand image or sacrificing long-term customer loyalty. Penetration pricing is an acquisition strategy for companies that are trying to gain a foothold in highly competitive markets. These companies penetrate the market by offering a lower price than their competitors, enticing customers away from their current provider in an effort to gain market share. By pricing below what current consumers expect to pay, companies can increase awareness of their product or service early on and attract customers faster. Instead of having to compete with established brands solely on the value their product or service provides, this penetration strategy helps companies acquire new customers through price alone. Once these companies have grown their customer base, they can start increasing the price to capitalize on willingness to pay. This process of raising prices is the most difficult aspect of a penetration pricing strategy, as customers who jump ship to go for the cheaper offering are more likely to do so again as prices increase. Penetration pricing is used to acquire new customers by pricing a product or service significantly lower than a competitor. The goal of penetration pricing is to offer a discount up front in exchange for awareness, market share, and ultimately the customer's willingness to spend more money in the future. A recent example of using penetration pricing was the successful launch of Disney+, which was priced aggressively lower than rival streaming services, including Netflix, Hulu, and YouTube TV. But penetration pricing isn't just for multi-billion-dollar corporations, it's used everywhere, from e-commerce platforms to your local grocery store. In this article, we'll break down some examples of penetration pricing and explore whether it's an advanced pricing strategy that your business could use to increase sales volume. Penetration pricing is an acquisition strategy businesses use to attract new customers by offering lower prices than their competitors. This strategy is commonly used when a new product or service needs to penetrate a competitive market, so the business entices customers with a better deal in hopes of retaining them over the long run. By setting an initial price below a customer's expectations, businesses can potentially convert more sales faster than competing with established brands, products, or services using a similar price point. Then, after establishing your brand image and acquiring market share, a business considers price increases or upsell new products. That's enough theory for now. Let's look at some real-life examples of penetration pricing. Penetration pricing examples. Depending on where you shop, you probably encounter a penetration pricing on a weekly or even daily basis. From big box retailers to the pizza shop down the street, businesses are willing to temporarily sacrifice profit margins in exchange for awareness and market share. Let's look at 3 penetration pricing examples in action and what you can learn from them. Understanding penetration pricing. Penetration pricing, similar to loss leader pricing, can be a successful marketing strategy when applied correctly. It can often increase both market share and sales volume. Additionally, a higher amount of sales can lead to lower production costs and quick inventory turnover. However, the key to a successful campaign is keeping the newly acquired customers. Successful penetration pricing. Penetration pricing is just the first step to a long-term plan to attract, convert, and establish relationships with new customers. In order for a penetration pricing strategy to work, it must often meet the following criteria or adhere to the following guidelines. High product demand. Penetration pricing is most effective when there are goods in high demand. If there is not a large market for a product, it often is less important the price of the good because there are less consumers to capitalize and attempt to retain. Therefore, the most successful penetration pricing strategies rely on broader markets with more exposure where a single penetration pricing strategy can have the greatest effect. Avoid price wars. Though easier said than done, the goal of a pricing strategy is not to get into a spiraling competition with another company. The purpose of penetration pricing is not to simply offer a very low price. It is to most effectively take market share. Price wars can be expensive, ineffective, and may publicly damage the reputation of a company should the battle ineffectively evolve. Pursue economies of scale. As the company attracts new customers, it is imperative that the company seeks out economies of scale. With more customers, the company should be able to more efficiently use resources, obtain pricing, and scale operations. For example, consider a company ordering raw materials for inventory. With more customers and more orders, the company should be able to purchase larger quantities and reduce its cost per unit produced. Gradually make changes. One of the worst strategies to employ with penetration pricing is to raise the price back to normal too quickly. Not only does this open the door for a competitor to swoop in and employ their own penetration pricing strategy, but quickly making changes breaks customer trust. With the customer on board with the new company must slowly make changes and gradually raise prices to more profitable levels, else it will face the risk of losing the long-term value. Build long-term loyalty. Though penetration pricing is a short-term strategy, the ultimate goal is to foster long-term loyalty. That means honoring existing pricing where applicable, understanding limitations on what can be offered, and still emphasizing value in product quality and customer service. As many telecom companies offer sign-up bonuses or one-time incentives to switch providers, it is then their responsibility to foster the business relationship. Companies that employed penetration pricing themselves may be exposed to penetration pricing counter strategies when they finally decide it's time to raise prices. New companies. Most often, penetration pricing is used by new competitors entering a market for the very first time. These companies do not have an existing presence in the market and are often not known or may be young. These companies may have limited resources, so they may not be able to deploy capital for aggressive marketing campaigns. The ultimate goal of these new companies is to steal market share from market leaders. Established brands offering new products. In other cases, more established companies may introduce new products to the market. Although the brand name may be recognized and known, the company may not be known for some specific products. Because the company may have a large stockpile of resources, it often is able to sacrifice short-term profits in favor of establishing itself in a new market. Price-elastic brands. Last, some companies may use penetration pricing for items that have high price elasticity. Price elasticity is the relationship between demand and price for a good. If a small change in price creates a large change in demand, the price is said to highly elastic. In these cases, a company may very slightly reduce its price to achieve the benefits of the price elasticity. It's also important to monitor and adjust pricing strategies as needed to ensure they remain effective. Customer preferences and market conditions can change rapidly, so companies need to be able to adapt and pivot if their pricing strategy is no longer resonating with target customers. In addition, companies should consider the impact of penetration pricing on their supply chain and profit margins, as they may need to adjust production processes or reduce costs in other areas to maintain profitability. In conclusion, penetration pricing can be an effective tool for businesses looking to enter a new market or gain market share quickly. However, it should be used strategically and implemented carefully to avoid damaging brand reputation, sacrificing long-term profitability, or triggering price wars with competitors. As with any pricing strategy, careful research, a deep understanding of customer needs and preferences, and long-term planning are essential for success. Penetration pricing may occur every time you use a coupon, as a company or product is trying to lure you into paying a lower price in exchange for your business relationship. Pros of penetration pricing. The primary advantage of penetration pricing is that it may be one of the quickest ways to convert a customer. Many customers may not be loyal to a specific brand. In these cases, it may be easiest to simply offer a lower price to attract their business. Whether a company is a service company, retailer, or manufacturer, all types of companies can offer penetration pricing strategies. Companies can successfully use this short-term strategy and leverage new customers into long-term success. Companies can capitalize on goodwill earned when their pricing discounts were available, and this may foster brand recognition for being one of the low-price providers in an industry. As long as consumers associate the penetration pricing company as the low-cost provider, there will always be long-term brand equity created via penetration pricing. Penetration pricing also fosters loyalty because consumers directly benefit from the lower price. Though some of this loyalty is jeopardized as a company begins to raise its prices in long term, Consumers may not directly benefit from conversion tactics quite like they can when companies battle over lower prices. Penetration pricing may also help naturally foster economies of scale. If pricing is aggressive enough, a massive amount of customers may be converted. As a company has larger order quantities and is able to build greater infrastructure, it often experiences less cost per unit due to manufacturing or operational efficiencies. Cons of penetration pricing. Though customers are attracted by a very low price, it may not be feasible to offer that price forever. The new company is trying to eventually make a profit, and some penetration pricing strategies result in short-term losses. A company must be able to temporarily cover its expenses if it is not earning enough from customers during the penetration pricing period. Once customers are lowered, there is a significant risk of consumers leaving once prices are increased. Consider the fact that a consumer lured by penetration pricing may leave because of another penetration pricing strategy. A company must be incredibly sensitive to raising prices, changing contract agreements, and making changes in the long term. Some consumers may view penetration pricing as an unfavorable marketing tactic. A company may get the reputation of having lower quality goods should consumers inappropriately associate low prices with product quality. Consumers may also see through the strategy and not appreciate the attempt to be bailed by short-term marketing tactics. As other companies take wind of what is happening, they may decide to price match or further reduce their own price. In addition, many companies now offer price matching and may have a greater warranty or customer service process. Companies must move delicately as creating an expensive price war often leaves the new company in a less favorable position than before. Last, penetration pricing strategies are not useful as long-term strategies. They take effort to create, then a company needs to change direction again and deploy more resources to create long-term value. These changing strategies may be burdensome to finance and must be aligned in order to effectively streamline a short-term customer into a lifetime purchaser. Pros. May be one of the fastest ways to convert a customer. Can be used by a variety of types of companies. May foster brand recognition as the low-price provider. Directly benefit consumers. May foster economies of scale. Cons. May result in short-term losses. Must be gradually phased out as customers may leave as easily as they were lured. May result in price war which leaves the new company in a worse position than before. Not useful as a long-term strategy by itself. Moreover, companies should always keep an eye on the competition, closely monitor metrics like customer acquisition cost and customer lifetime value, and be willing to make adjustments to their pricing strategies as needed. By leveraging the benefits of penetration pricing, businesses can successfully enter new markets, establish themselves as market leaders, and drive long-term growth and profitability. Penetration pricing versus skimming. With pricing penetration, companies advertise new products at low prices, with modest or non-existent margins. Conversely, a skimming strategy involves companies marketing products at high prices with relatively high margins. A skimming strategy works well for innovative or luxury products where early adopters have low price sensitivity and are willing to pay higher prices. Effectively, producers are skimming the market to maximize profits. Over time, prices will reduce to levels comparable to market prices in order to capture the rest of the market. Small businesses or those in niche markets can benefit from price skimming when their products or services are differentiated from competitors and when synonymous with quality and a positive brand image. Real-world examples. Costco and Kroger, two major grocery store chains, use market penetration pricing for the organic foods they sell. Traditionally, the margin on groceries is minimal. However, the margin on organic foods tends to be higher. Kroger and Costco use a penetration pricing strategy when they sell organic foods at lower prices. The lower costs allow Kroger and Costco to maintain their profit margins even while undercutting the pricing of their competition. Cell phone carriers also implement penetration pricing by offering the latest cell phones when a new consumer agrees to a long-term service contract. For example, T-Mobile, and other carriers, now offer a free phone when a customer switches to a T-Mobile plan from a plan with another company. The company can't simply survive forever by giving away these phones for free. Is penetration pricing ethical? Yes. Penetration pricing is a valid strategy as that is used to temporarily offer lower prices to attract a customer. There is nothing unethical or illegal about it, though there are very strong considerations a company must make once a customer has been attracted. For example, once a new customer has agreed to a long-term contract, it is the company's responsibility to honor that agree even it is unprofitable and not bait and switch the customer. When would a company use penetration pricing? A company uses penetration pricing when it does not have a presence in a given market. Whether it is a brand new company or an old company introducing a new product, most penetration pricing strategies occur when new products are introduced and a company wants to steal market share from existing companies. What types of products are most successful with penetration pricing? The most elastic goods are often the most successful with penetration pricing. These goods often have the largest changes in demand with very subtle changes in price. Goods such as internet, cable, banking services, groceries, airline tickets, or hospitality services are often easier to use. Penetration prices with small changes in price may more easily swing demand. The bottom line: penetration pricing is the short-term strategy to lure customers from competitors by offering lower prices. Though these prices may not be profitable in the long term, a company's hope is they can convert the customer into a long-term relationship that ultimately yields a profit per consumer. However, it is important to note that penetration pricing is not a one-size-fits-all strategy and may not work for all types of businesses or industries. It is crucial to carefully consider the market conditions, competitor pricing, and the target customer base before implementing this pricing strategy. Additionally, businesses should be mindful of the potential drawbacks, such as a decrease in perceived product value and the challenge of raising prices later on. Ultimately, the success of penetration pricing will depend on the company's ability to execute the strategy effectively and adapt to changes in the market. Thank you for watching the video and subscribe the channel.